Time now for Options Corner. Joining us to take a deeper look at this chart is Rick Ducat, lead market technician. All right, Rick, let's get right into this. What trends do you notice on this chart for UPS?
Yes, good morning. As you said, the laggard here, certainly far lower than its industrial sector here. The XLI ETF up about 14%, while the broader S&P 500 up almost 17%. UPS, on the other hand, down about 35.5% here. So a difficult situation for this company here. Things don't look too terribly much better when you compare it to its own sector, air freight and logistics. FedEx doing far better, about 12.4% down. In this case here, also CH Robinson and Expeditors International here, kind of a smaller subsector here of the S&P. But anyway, when we look at our candle chart here, trending downward for the most part, but a bit of stabilization at these lower levels. If we were to examine our recent range in which we've been trading, you can see this green line here at the lows around 82 was a pretty consistent floor. Meanwhile, we topped out at these upper levels here around 89 at our red line here. So now we are close once again to this red line for our resistance area. We also are coming into focus once again toward our downward sloping trend line that represents our continued descent from those highs here. So if we were to look at some of our other studies, we can see that we are trading right around our orange 63-day exponential moving average here. We remain above our yellow 21-day. So things have improved somewhat modestly here. Our yellow 21-day EMA is starting to slope upward here, but earnings could really be a major catalyst that could change things significantly here. One important thing to consider, our volume profile point of control, our volume profile here being our blue bar graph on the right side of the screen. Our thick red line is our point of control, the area of heaviest trading here. We have a notable low point, repeated tests of support near the 82, 83 level, and our point of control is at these low levels here. That would often be interpreted that this could be a significant low point on our chart here. Certainly not saying it's going to hold or that this won't be, the precursor to further declines here, but that is what you would hope if you had a more bullish outlook in this chart, that this would be a notable low point here. If you were to move a bit upward more, 98, another resistance level, that's where our next heavy trading area is, so that could be another upside point to watch out for. To the downside, our linear regression line, our line of best fit, that comes in a bit below those lows near about 78.60 here. So those could be some shorter term boundaries to consider.
Okay, thank you, Rick. That is Rick Ducat, our lead market technician. Now to take us through an example trade, Tom White, senior options contributor and co-host of Fast Market. So, Tom, what's the approach for an example trade? I mean, UPS has had, a very rough year, and even recently we've seen a bunch of analyst price target reductions. Where do you take this?
Yeah, a lot of headwinds for this company. Remember in August of 2023 when they signed that new deal with all their employees, everybody thought that was going to be, a Kickstarter for this company. But the stock's actually fallen since, and it's down 30% so far this year, hitting multi-year lows recently. Applied volatility really elevated going into this report tonight. This is going to be one of those make or breaks because small businesses, which they rely on, not doing that well. They lost half of their Amazon business into the end of this year and at the beginning of next year. And they're still paying a 7.5% dividend yield. We'll see if that thing gets cut because they're paying out almost all their profitability in those shareholder-friendly deals on dividends and buybacks. So I looked at a strategy. If you think it's going to rebound, the short interest is built up in here. Any surprise to the upside might send the stock higher. This is a bullish call diagonal here. I'm going to go out to the November 14th weekly option. So 18 days to expiration. We're going to buy the slightly in the money 87 strike call. It's got the higher delta. It's going to react more like the stock. And then I'm going to go sell in the October 31st weekly options that expire in just 4 days. You're going to capture that earnings event in that option series. We're going to sell the 93 strike call. So a bullish $6 wide call diagonal to the upside. You're going to pay roughly, if the stock opens up here, about 87.5, about a $3 debit. So $6 wide, you're only paying $3. So half the width of this bullish call diagonal in here. Now, the option market pricing in about a plus or minus $6 move in the shares, nearly 7%. So this aligns with what the option market's pricing in. But anything above about the $88 level is going to be profitability on this 2-week wide bullish call diagonal. Why? Why is it cost so little for a $6 wide bullish call diagonal? Well, you're buying about a 46% implied volatility on aggregate on that 87 strike call you're buying in the the November 14th options here, and then selling about an 83% implied volatility on aggregate. So that dispersion causes the lower price point. Only do this if you're bullish on it. If you're bearish, it's about the strategy. Do a put diagonal.
All right, great context for that one. Thank you, Tom. That's Tom White, our senior options contributor and co-host of Fast Market.